Welcome to the Center for Global Development. I'm Lawrence McDonald. I lead the communications and policy outreach work here at CGD. And we're delighted to have this opportunity to host this presentation of new IMF and also some joint IMF World Bank analysis of the risks posed to low-income countries by the current global economic environment, and also in the second paper some exploratory questions about contingent finance, what the rich world might be able to do, or what I should say the international financial institutions might be able to do in response. Both of these topics fit very squarely within the CGD mission. Many of you know our work here well, are old friends of ours. A few may be new, and let me say that we focus, unlike the World Bank and the IMF and most development organizations that provide advice and support to developing countries, we look through the other end of the telescope. So we try and improve the policies and practices of the rich and powerful, and that includes, of course, the international financial institutions. There's obviously huge concern about events in Europe, with very good reason, because the spillover effects all around the world. We're particularly concerned about the spillover effects on the poorest people in the world, many of whom live in the low-income countries. So this is really an ideal topic for us. I'm delighted to welcome our first speaker, Ming Zhu, or as we would say in China, Zhu Ming. Mr. Zhu is the Deputy Managing Director at the IMF. He assumed that position in July. He was previously the Deputy Governor of the People's Bank in China, and before that he was at the World Bank. He has degrees from both Fudan University and from Johns Hopkins. Mr. Zhu, when you walked in the door, you looked so familiar to me. I guess I looked a little bit familiar to you, and I realized that we worked together in the Policy Research Department at the World Bank back when Nancy Birdsall, the president of our center, was the director of that department. So I feel like I'm welcoming an old friend. Very pleased that you can be with us today to kick that off. Following that, we'll have a presentation of the key findings of the papers, and then we have two very distinguished discussants that I'll introduce later who will give us remarks. The IMF is famous for its discipline, fiscal discipline. I'm famous for my discipline in keeping people to their assigned time. The only real exception is that, Mr. Zhu, you may speak for as long as you like, but my other three speakers, I should tell you I'm going to be very tough. So, please.
Thank you. Thank you, Larry. Thank you, Larry, for your very kind introduction. Okay, guess you give me extra time because we were old friends. You know, you just cannot believe after so many years we meet again and here. And also, thank you again. You are the first one can distinguish me from Ming Zhu to Zhu Ming. You know, I'm a Chinese. I was born in China, so I'm Zhu Ming always because the last name first, the first name last. Then 30-some years ago, I came to the U.S. I become Ming Zhu, right? The first name first, last name last. Then 15 years ago, I went back to China. I become Zhu Ming again. So last name first, first name again. So when I come back this time, I myself and everybody was confused. Should I be Zhu Ming or Ming Zhu? So thank you very much. You are the one that understand and can distinguish both of that. That's absolutely amazing. And it's given me a great pleasure to say a few words to open the session. And I would like to thank you, Larry. Thanks for the center to organize the whole thing and invite this very distinguished panel. And I think also invite all this very distinguished audience as well. We're going to talk the issue I think is very important today. And when the whole world eyes on the Europe, I think we should not forget the low-income country, the poorest country in the world. In the past 5 years, the low-income country has been hit 3 times already by the crisis that is not made by them. The first one is 2007, which is the food prices, fuel price, and they were hit badly. Then followed 2008, then the global financial crisis hit them again. And now we just see a big crisis coming, which is obviously the European crisis. The World Bank estimate at the end of the year 2010, 64 million people left in poverty because of the financial crisis. So this is a very serious issue. I would say the low-income countries weather the past two crises quite well, and because for the previous roughly 10 years, the low-income country working very hard to build the policy buffers. They have a relatively lower fiscal deficits. They have a relatively lower current account deficits. They had a relatively lower and also debt level as well. So when the crisis comes, they have a more policy buffer. With help from international community, they will be able to do the fiscal stimulus. They will be able to catch up quickly. So when 2009 and 10, the global economic growth picked up, they will be able to pick up. So they had actually strong growth in 2010. For example, for Sub-Saharan Africa countries, the average growth rate was reached 5.4%, which is way strong, way high, which is very good. But now, when they are facing the new crisis from Europe, the situation is quite different, because the fiscal space is much, much more smaller now. And the current account deficits also in some degree increase. The debt level increase as well, because they use a lot of stimulus packages in the past 2 years, try to promote the growth, to maintain the social stability as well. And because its time is too short, they didn't have time to build the buffers they need. So when the new financial or global and sort of European crisis are coming, I think this is another big challenge for low-income countries as well. We estimate if the global growth rate drops to 1.5 percentage points, it will need, in addition, $27 billion for external financing for poor countries. It will bring another 27 million people, draw them into the extreme poverty as well. So in this case, when we're looking for the global situations, we're obviously working with European leaders to try to find comprehensive solutions. This solution not only important for Europe, but also important for the whole world, and particularly important for the low-income country as well. Low-income countries are doing a lot of things, and rebuild the buffer, expand the tax revenue basis, try to make sure the expenditure very carefully, but also make sure expenditure, particularly for the social area, education, healthcare, social, for the poorest in the poor country as well as maintains. But they need help and assistance from external, from international communities. That's the way we are. We at the fund is very much determined to carry our mission, one important part, to maintain financial and economic stability for the low-income countries, to promote sustainable and inclusive growth in low-income countries as well. During the crisis, we doubled our capacity for concessional loan to $17 billion through 2014. We cut our concession loan interest rates to 0 through 2012. We make our instruments much more flexible to be able to reach out to the countries in need in due course. But obviously, more needs to be done. So that's a reason we are very much focused on to monitor, to manage, and to test the external vulnerability issues, the external shock, and to the vulnerability to these low-income countries as well. That's the reason we represent you two pieces of work done by the fund, and Hugh will do the presentation for you, and very much on the global growth risks and the commodity prices on the low-income countries as well. It is absolutely important issue given the situation today. I think the low-income countries are working to protect themselves, and we as international community should help them and should support them. This is two pieces of our work. We're very much looking for your comments. We're very much looking for and very stimulating and interest discussion in these areas. I thank you for your guideline and for your help in advance. Thank you.
朱先生，谢谢你。Thank you. Thank you very much for that comment. It's now my pleasure to introduce to you the man tasked with the impossible task of presenting in 20 minutes the key findings of these two papers. The papers themselves, our colleagues from the IMF have been kind enough to provide copies in the back, so if Hugh has to leave out some details, the papers are available to you. The first of them is Managing Global Growth, Risks and Commodity Price Shocks, Vulnerabilities and Policy Challenges for Low-Income Countries. That corresponds to the first idea I mentioned of the likely impacts on poor countries of events in the mismanaged rich world. And the second has to do with contingent financing. That's jointly with the World Bank, managing volatility in low-income countries, the role and potential for contingent financial instruments. Hugh, we look forward to hearing from you about these two important papers. Thanks very much.
Thanks very much, Larry, and may I add my thanks to the CGT for hosting, for my discussants for agreeing to participate today, and for everybody for coming. Just to emphasize, as Larry mentioned, one of these papers is joint with the World Bank. I think we have one of the colleagues who worked with us on this paper, Julie Dana from the bank, in the audience today. I hope she's here somewhere. First of all, to put this work in context, both of these studies are part of a trend, a shift in the IMF, shift in focus to look more at risks and vulnerabilities. We, of course, the fund is well known for its WEO forecasts, its baseline analysis, and so on. But I think what we've realized over the years is that one of the value-added contributions that the fund can make is to look at what can go wrong, look at downside risks. We really started to focus on this after the Asian crisis, and we created what we call the vulnerability exercise for emerging market economies, which looks at the risks of sudden stops, capital flows, capital account risks, and exchange rate pressures. When the 2009 crisis broke, which was obviously centered in advanced economies, we decided we needed a similar kind of approach looking at advanced economy risks. There, the focus was more on financial crisis vulnerabilities and risks to growth. And then this vulnerability exercise for low-income countries is in a way completing the map, so that we now have all of the different groups of countries covered in this sort of vulnerability approach. And each of these vulnerability exercises feeds into what we call the early warning exercise, which is a process that allows us as an institution to identify what we consider to be key tail risks in the global economy. We do this every 6 months ahead of the meetings of our ministers. And in that exercise, we try and identify not only what the risks are, but what policymakers should do about them, and hopefully translate that into preemptive policy action. I was just describing these three vulnerability exercises feeding into the early warning exercise. So turning to low-income countries in particular, I think it's probably well known to most of the audience here that low-income countries, one of the stylized facts about them is that they are more exposed to volatility than the rest of the world. This chart just shows that fact. It shows the volatility and growth having declined over the last 3 decades, but low-income countries still are more vulnerable than the rest of the world. And it's also another stylized fact is that the more volatile growth is in looking just at the low-income countries, the more likely it is that they will have lower long-run GDP growth. So these kinds of shocks are not only directly welfare reducing, but they are also associated with lower long-run growth and development performance. And of course, these economies, you can easily understand why this is the case. These economies tend to be less diversified, more limited economic structures, less cushions, both for the public sector and the private sector to fall back on when they're faced with negative shocks. And that's why you see more adverse effects in these countries. So, as I said, work agenda in the fund is generally moving towards looking at risks, volatility. In the low-income countries, we have done and are in the process of doing a number of relevant studies. This one, the first paper I'm drawing on today is from this vulnerability exercise to identify emerging risks and also look at the implied policy responses and also what countries can do to protect themselves against imminent threats. The second piece of work I'm talking about today, this work joint with the bank, looks at what tools, in particular financial tools, low-income countries can use to protect themselves or to cope with shocks when they materialize. And then we have a range of other pieces of work in the pipeline. I won't go through these in detail, but all of these topics I list here are in one way or another related to resilience issues, coping with shocks, or minimizing the risks from shocks. And we no doubt will, if you keep your eye on our website, you'll see papers on these topics coming out over the next year or so. So just to give a background to the vulnerability exercise itself, which we did for the first time, having developed the framework, and if you're interested in the analytical framework, there's a paper on this on the fund's website that was published last April. But this fall, we launched on the first full-fledged exercise, starting with the world economy baseline and then looking at the risks. The background to this, of course, is that we're coming out of a one big downturn in 2009. The low-income countries have, contrary to historical experience, this time have recovered very quickly, and their recovery has been synchronized with the rest of the world this time, I think reflecting the fact that they're much more integrated with the world economy now than they were during previous crises. We've also had, of course, volatility in commodity prices, surge, then a drop, and then recently another spike in commodity prices. In general, the inflation effects have not been too bad by and large, with some exceptions. We've seen pockets of high inflation re-emerging in East Africa, for example. But if you look at low-income countries in general, the inflation performance has not been that bad. So both growth and from a growth and inflation sort of macro stability perspective, the recovery from the crisis this time was relatively positive. Less good news is that in terms of looking ahead and thinking about how well placed these countries are to deal with future shocks, the fiscal position, of course, began to recover last year as growth recovered and fiscal revenues recovered, but countries are nowhere near back to the fiscal positions that they were in prior to the 2009 crisis. And indeed, the progress that they were making in 2010 basically came to a halt in 2011, partly because of the commodity price shocks, which induced then increased subsidy payments and various sort of safety net type measures, partly because of a pickup in investment, which of course not necessarily a bad thing, but nevertheless the fact remains that this rebuilding of their fiscal positions is far from complete. And if there wasn't the blue box there, you'd be able to see that the same story is basically true on the external side, where the current account position has yet to revert. So looking at the risks then of a downturn, we looked at basically two, at least what we thought at the time, were tail risk scenarios. The first one is to a risk of a global downturn, so if you like, a global double dip, since we've already had one downturn in 2009. And the second scenario, which I'll come on to in a minute, is for a further resurgence in commodity prices, so a spike in commodity prices. In terms of the global downturn, so first of all, this is the baseline forecast against which we simulated the downturn. So again, you can see that the outlook, this is the September World Economic Outlook. The outlook was for some very moderate continued recovery in growth, and pretty much flat or slight improvements in some of the external and fiscal buffers. Again, sorry you can't see the fiscal chart here. So we then superimposed on that a downside shock of 1.5%, taking 1.5% off global growth in this year and next year. And that was simulated in the World Economic model as a Eurozone financial crisis, which then propagated. And so all the spillovers throughout the world were modeled in the World Economic model. And we took those results and translated them into impacts on low-income countries, taking account of trade channels, foreign direct investment, remittances, and also commodity prices, since the world model, if you put in a big negative growth shock, commodity prices will tend to be weaker. So embedded in what you'll see here is both a growth shock and a negative commodity price shock. And you can see here that not surprisingly, it knocks off the recovery in LIC growth. They go back into lower growth path. Growth still remains positive, even in per capita terms, but the recovery is brought to a halt. So 1.5% global growth knocks about 1% off low-income country growth, according to our simulations. And the external and domestic buffers all, of course, worsen quite significantly under this scenario. And we also estimate that this kind of shock would push an additional 23 million people into poverty next year. That's based on various modeling tools that we imported from the World Bank and apply in this framework. So that was the downside scenario on growth. We also looked at a surge in commodity prices. Obviously, these two risks are not likely to materialize together. The resurgence in commodity prices would most likely happen if we didn't get the negative growth shock and we got some recovery actually in confidence and global growth, a bit like what we saw in late 2010, early 2011. And it doesn't take much, as we saw then, for growth for commodity prices to really take off if confidence returns. So, there's some progress. Thanks. So, the somewhat surprising thing, people are often surprised by this finding, that because you normally think of low-income countries as all being sort of commodity-based economies, you'd think higher commodity prices would benefit them. In fact, it depends what indicators you look at, but if you look at the trade balance, in fact, most low-income countries would suffer from a generalized increase in commodity prices, and that's because so many of them are fuel importers. The vast majority actually are fuel importers, and actually most, even though they're food producers, are on net also food importers. So you can see the red and yellow bars here show that most low-income countries would suffer under this scenario, where all food and fuel and metals commodity prices are all rising. The exception, not surprisingly, are the net oil exporters, which gain from this. The one area where all countries are affected negatively, though, in this scenario is on inflation. Here you can see our baseline forecast for inflation at that time. Again, you can see inflation generally moderate levels in the sort of on average about 7%, in the 5 to 10% range. With this shock, inflation would essentially double, assuming normal, assuming historic policy responses, if you like, average policy responses, inflation could roughly double. And again, we can simulate the poverty impact from this. And this here we're looking at actual effects on household budgets from the price increases. So we take into account the shares of these various products in the household budgets. So we would end up here with 31 million more people in poverty. So the poverty impact of this shock is bigger than the growth one, even though the growth shock is, in a macro sense, more substantial. Of course, I've talked about sort of very broad brush effects. The impacts do vary, in some cases quite significantly across country groups. Here I'm highlighting two of what we call the sort of policy buffers. One is the fiscal space measure, and another is the foreign exchange reserve coverage measure. And these are the baseline values for these buffers. So you can see that in the baseline, low-income countries on this measure have positive fiscal space, which means that most of these countries, or the median country, has some room, actually, even in the baseline, to spend a bit more or cut taxes without impairing long-run debt sustainability. The exception there, and you can see commodity exporters have had very large or relatively large fiscal space. Small economies, on the other hand, most of these are island economies, some in the Caribbean, some in the Pacific, are very fiscally constrained even in the baseline. Reserve coverage sort of scattered around a sort of notional benchmark of 3 months of imports. But if you start adding the shocks, and here I add the global growth shock first, you see that low-income countries in general move into negative fiscal space territory. Commodity exporters being an exception, but small economies are obviously pushed way into the negative territory, meaning if they were to restore fiscal sustainability, they would have to raise taxes or cut spending. And reserve coverage is also impaired to a lesser extent and to varying degrees across countries. And if you add the commodity price shock, there you get sort of intermediate effects. The impact on fiscal is still significant and pushes countries into negative territory, but the impact is somewhat less, and likewise on reserves in general. Now, the question is, what implications does all of this have? As I said, when we started on this exercise back in the summer, we sort of finished it in September, the global downturn scenario looked like a tail risk. Of course, now it doesn't look so much like a tail risk anymore. We've seen the sort of nascent recovery in 2010 and early 2011 take a nosedive in recent months. Here's a couple of, one indicator at the top shows that for advanced and emerging, as well as the entire world, looking at it from the manufacturing. This is sort of forward-looking index perspective. And you can see that the global financial stresses, which of course are largely, if not entirely, related to Europe, which had eased in late 2010 and early 2011, have picked up again. So this is now a serious concern, and the question of what policymakers in low-income countries should do if the shock materializes has become a real imminent issue. We also can see here that these sort of negative indicators are translating into downgrades in the consensus forecast for growth in 2012, and the IMF's own forecast will go in that direction too. So how should they respond? As I pointed out, the fiscal space has not been fully rebuilt since the 2009 crisis, and so you can see that again in the chart on the right. If you compare the left bar is sort of fiscal space prior to the previous crisis, and that was used up essentially in 2009. The little negative bar there. On the right-hand side, you can see the starting point for fiscal space this time around, starting with less room for maneuver, and the shock would push them into further into negative territory. At the same time, the prospects, if a shock does materialize, the prospects for aid to rise to help finance some of the shock response is almost certainly worse now than it was in 2009. We were concerned about what would happen to aid last time around. In the end, aid budgets did actually expand in 2009. The chances of that happening in the current fiscal context have to be more bleak. Nevertheless, our policy line here and our advice to our member countries would be, to the extent possible, which means countries that do have at least some fiscal space, to some room for maneuver, they should aim, as they did last time, to at least maintain spending to soften the economic and social impact. Countries that don't have fiscal space, or in cases where the downturn is not just a short-lived double dip, but actually a protracted recession, which is possible, then countries will have to start looking at strengthening revenues and prioritizing spending, so making savings in some places to protect the core development budgets, social spending, and so on. If commodity prices rise, the key issue here typically is the pressures that are associated with the inflation shock and the shock on household budgets. And these create tough policy choices, in particular because in many of the low-income countries, the effect of these price shocks on commodity budgets is not just felt in low-income households, but it extends well into the income distribution. And you can see, as you can see here, especially for sub-Saharan Africa, the negative impact is pretty much proportional terms, pretty much the same for the middle-income groups as it is for the low-income. And of course, that means that the political pressure for safety net responses, subsidies or whatever, pressures on governments are very extensive and strong. The first best response in these contexts is, is typically, we say, is to pass through the prices to the retail level, but then protect the vulnerable groups. But the problem is, of course, to do that, you need a targeting framework. You need a well-developed social safety net that allows you to reach the vulnerable groups at reasonable cost. Most low-income countries don't have that technology at the moment, so they need to think in terms of second-best policies, cost-effective measures that can provide relief without imposing unsustainable costs on the budget. And we do have a number of examples in the paper of countries that managed to do this in 2009 through various creative ways, using cash transfer schemes, school feeding, targeted subsidies to particular types of energy that are consumed by the poor, and these kinds of things. So it is possible to do, but that requires some careful management, and it's good. It would be good for policymakers to start thinking now, if they haven't already, about how they would do this in practice. Then, thinking beyond the the current shock, and let's suppose that the good scenario materializes, we don't get a double dip in growth, or we don't get a commodity price shock. What should countries be doing now to protect themselves in the event that those shocks do happen in the future? And here the key message of the paper is that they should be working to rebuild those buffers that they used up in 2009. That the chart on the right just illustrates the payoff that you get from these policy buffers. It shows the increase in government spending across different categories of groups with different degrees of fiscal space. So on the left, where you have countries that had ample buffers both on the fiscal and external side, they were able to mount very significant real increases in government spending during the downturn and to support their economies and protect their populations. Whereas the countries with more limited buffers, either on one or both of these dimensions, were able to do much less in terms of fiscal response. So these buffers really do pay off. The problem, of course, is that building buffers has an opportunity cost. If you're going to, for example, if you're going to reduce your debt or increase your deficits or put money into reserves, that's money that you're not spending on investment, even on good things like education and health and so on. So there is a trade-off here between building buffers and some other spending priorities. But what we highlight in the paper is that you can take measures to ease that trade-off. One obvious way is to work on domestic revenue mobilization, strengthening fiscal revenues. You can manage your public spending better and have targeted social safety nets that are more efficient. Managing your liabilities, which means not only keep prudent borrowing, but also ensuring that you borrow on terms that protect you against future shocks. So you try and borrow on long maturities, minimize your exchange rate risks and this kind of thing. In the longer term, you can also, as a policymaker, think of reforms to financial sector that deepen the financial sectors or promote economic diversification as being not only good for development, but also making your economies more resilient to shocks. And you can think about how you would, what kinds of financing you would fall back on in the event of shocks. And here, it's not only the buffers that you build up, the self-insurance, if you like, but you can also think about instruments that you could use that would draw support from donors and financial institutions and also private investors through financial markets. So this is where we come to the second part of the presentation, on the second paper. So just to start on this, as I said, there are two approaches to managing shocks. You can either self-insure by building these buffers, or you can draw on external financing when the shock materializes. And there are two types of external financing you can draw. There's the ex post, which means when the shock hits, you go and arrange financing from somebody. IMF financing is an example of this, where facilities exist, but you have to go and negotiate the terms and get access to those facilities after the shock hits. Or you can use ex ante forms of external financing, by which we mean these contingent financial instruments. We mean things like hedging contracts, where you by entering into these contracts in advance, hence ex ante, you secure for yourself potential financing in the event that bad things happen. Likewise, contingent debt instruments, meaning debt instruments where the repayments are contingent on bad events, and insurance, disaster insurance, this kind of thing. Now, there are trade-offs between these different types of instruments. I mean, you want, on the one hand, as a policymaker, you want financing that you want to be sure that the financing is going to meet your needs, so that it's tailored to fill whatever the financing gaps are that you face. But you also want that financing to be relatively predictable, so you know it's going to happen. And those two are it's difficult to achieve both of those objectives simultaneously. The more that you tailor to financing needs, the more you have to leave it open, exposed as to how what kinds of financing and how much is provided. Likewise, the more that you specify and pin down the financing in advance, the less likely it is that that financing is going to exactly meet your needs. It could be more, it could be less than you really need. And all of these instruments that I listed, I won't go through them, but these are all instruments that exist right now and are on this sort of on this spectrum here from ex post to ex ante. These IMF facilities, as I say, are mostly ex post. There's also the moral hazard issue here, to the extent that the more that you try to make the financing predictable and sort of pin it down in advance, the more you run into the problem that countries could then game the system, take actions that could actually influence the amount of payoff they get from these instruments, and you obviously want to minimize that problem. So I'm going to talk now briefly, just to wrap up, on the ex ante aspects, because that's what's sort of new, relatively new here. Instruments like hedging, these debt instruments and so on, how would we make these work? Well, the first step is, for countries thinking of using these, the first thing they need to do is have a proper risk management framework in place where they can do risk assessments, they can understand what the implications of these instruments are, how to use them, what the risks of using them are. They need capacity, local capacity, staff who understand the instruments. They need to be able to do the technical analysis, and they need the right institutions to govern the whole exercise. Focusing in particular on the debt instruments and risk pooling, and I'll mention what risk pooling is in a minute, you have these various design considerations to worry about. So, as I said, you want to minimize moral hazard, but you want to, as much as possible, in order to maximize the tailoring effect, you want to design these instruments so that the payoff from them is as closely related as possible to your financing gap. If it's a debt instrument, you want to tailor it to the repayment capacity, for example. So you need to balance exogeneity, which minimizes moral hazard, against linking to repayment capacity. You don't want to, for example, trigger to a payoff to fiscal revenues, because countries could, in the worst case, they could just cut taxes and say, okay, now we don't have as much fiscal revenues, we want this instrument to pay out. To get the relief to be as well tailored as possible, you want it not to be sort of an on-off switch, but you want the amount of relief or financing that's provided by these instruments to be graduated, so gradually to step up as your needs increase. And for risk pooling, which is where you have countries that are affected in opposite directions by a given shock, they can get together and pool their risks. You need their safeguards against the counterparty. So whichever country is drawing or paying in needs to be assured that the country that's drawing will eventually pay back. Let me skip through this quickly because I'm short of time, but just to say that there are various reasons why these instruments have not been used very much. There are supply constraints on the supply side, particular the fact that these haven't existed and haven't been tried in itself holds back the development of them. Not clear who would be the first mover, and there are of course a lot of concerns and lack of familiarity about sovereign risks in low-income countries. There are also constraints on the demand side, lack of technical capacity, political economy concerns about spending money on complicated derivatives and so on. And the result is that the cost of insurance goes up. Now, that we talk in the paper, I won't go into this in detail, but we talk in the paper about various ways that we think the international community could help deal with some of these problems and mitigate some of them, helping to build capacity, working on the risk management frameworks, providing technical support. Maybe even in some cases, and the World Bank actually already has some experience in doing this, in sort of underwriting or participating in some of the financial packages themselves. So just to summarize key messages, we're facing now increased global risks, and low-income countries are unfortunately now less well prepared to deal with them than they were in 2008. If the downturn materializes, those LICs that have the room to do it, should try to do what they did last time, which is at least maintain spending to soften the impact. If the shock doesn't materialize and they have some breathing space to prepare their defenses, they should use that breathing space to build up their buffers, and in the longer term work on reforms to their economies that will make them more resilient. On the international community side, we need to look at ways to help develop more predictable countercyclical financing instruments through the various the channels that I just talked about. And we do think that there's a lot of instruments available of the ex post kind. There are almost none that are being used of the ex ante kind. So we think this is an untapped area that the international community should look at. Thank you very much.
Hugh, thank you, and my apologies for that technical glitch. You coped with it very graciously, and I thank you for that. My apologies to the audience as well. Our next speaker is my colleague, Liliana Rojas. Liliana is one of the few people that I know who's both worked in the international financial institutions, including in the IMF and the Inter-American Development Bank, and on Wall Street. She brings a unique perspective in that way. She's also the chair of the Latin America Shadow Financial Regulatory Committee, which meets here twice a year, Liliana, which is composed of former ministers of finance, central bankers from across Latin America, very distinguished economists. Each time they look at a particular issue and then work very intensely over a couple of days to come up with very timely recommendations to policymakers in the region. Liliana, I'm looking forward to your comments on the presentation. Thank you very much.
Thank you, Lawrence, for your introduction. I'm very happy to discussing this paper by the IMF, from former colleagues. I thought that what I would like to add to this discussion and conversation, given that we only discuss and have only 10 minutes, is to complement what the fund has been doing with a little bit of my way of looking at this problem and new research that I'm starting to. Why don't I start by just pointing out two things? First, there are lessons from the past crisis, the 2008-2009 crisis, that perhaps could be useful to assess how vulnerable really those low-income countries are. Second, all developing countries, including emerging market economies, finance themselves, finance growth, finance all expenditure increases for having more prosperity in their countries through three methods. They can use domestic savings, they can use external savings, or they can use the proceeds from net exports. That's it. So, okay. So, what if we construct a very simple indicator, what I call a vulnerability indicator, that, and this is based on much more sophisticated work that I have, but this is just going to the core of it, that have only three variables and basically represents those three components that I've been telling you about, which are savings, which is right there, foreign savings through external debt, and the dependence on the net exports revenue, which is represented by the current account. If you were going to do that, and those points, there are countries. All of them are developing countries. This includes both emerging market economies and low-income countries, okay? And if you were going to construct an indicator that I'm not going to explain to you here. If you want, we'll discuss that later, but how it is constructed. And you formed that indicator in 2007, the year before the crisis. And then you ask yourself the question, what happened with economic growth in developing countries during the crisis? So, where were you in 2007? And then compare that with what happened with economic growth during the crisis. What you actually find is a negative relationship, meaning the more vulnerable countries were, according to this indicator, the more the decline or the less growth these countries experienced. Okay? So I've learned from that crisis, and I think that's useful to talking about a future crisis. So now, what is this whole table, many countries? Well, this is actually the countries under the LIC category, low-income countries, according to the IMF. In one of the papers, the definition of what countries are there are presented right here, okay? That's the vulnerability index, and those are the three components, which I'm not going to get into. And this is the ranking, okay? The number one is a country that was most vulnerable. I'm talking in 2007, okay? And it goes all the way to 49 countries, and my selection of countries is just based on availability of information. What are the blue lines? Why are those countries marked? Because within the LICs, these are the really poor countries of the world. These are the countries categorized as the lowest income countries according to the World Bank definition. So this is where they were in terms of vulnerability indicators in 2007, okay? Now this is all, of course, background, because what I really want to know is, say that I update my index, say that now I take the most available data to calculate the vulnerability indicator, and I want to ask myself a question: are the poorest countries in the world worse off, better off, or the same relative to where they were in 2007? So that's exactly what I do. You're going to see in a second that countries in red are the ones whose vulnerability have increased. Yellow, equal. And green, they have actually improved. They are better prepared to deal with an external shock. This is what I found. Using the latest data, most of them from the IMF, what I found is that the lowest income countries in the world actually are in red, meaning that they are more fragile now to an external shock. So if the European problem actually materializes, the countries in the world that are going to suffer the most is not only the LICs, it's those within the LICs that have the lowest level of income and development. Even more, if I were to do the same exercise, but now I include in the exercise all developing countries, not only LICs, but also emerging market economies, right? I'm including some of the Latin American countries, Russia, India, a number of other countries that are not necessarily LICs. And I take the subset of countries. I didn't have time to present all the information, so I'm summarizing it, right? So if I take that group of countries in the world that, according to my indicator, are going to get worse off or are worse off right now, what I notice is that the largest proportion of countries are those that are the lowest income countries again. In just as an example, if you compare, the green is the proportion of emerging markets, and basically what you have is that countries whose vulnerability have increased, the number of lowest income countries the share is almost double than that of emerging market economies. Okay? So what I basically want is to raise a flag, raise your awareness that if a shock materializes, we are not just talking about the leaks. We're talking about the poorest countries in the world are the ones that are actually most affected. So, having said that, and this is basically my way to complement the first part of the paper, on the second part of the paper, I only have one slide because I know the 10 minutes. Okay. The way we can conceive the different instruments that can be used by countries could actually be done using kind of an insurance framework. In an insurance framework, basically you can use self-insurance mechanism or market insurance help or hedged kind of mechanism. And you have three kind of shocks in this table, which is actually taken from Paris, but this is not new at all. This is something that I want to underline a lot, okay? These kind of tables or analyses, the earliest that I could find was by Eric and Becker in 1972. Okay, so the issues are not really new. It's just that now we are trying to move the agenda forward. But if we analyze that there's shocks like terms of trade, natural disaster, and capital flows, and there are different ways of coping with the facts, right? I mean, sometimes it's with just aid, and sometimes it's with all kind of different market-based instruments. Well, as I'm saying, we have been in this agenda for a very long time, and really the movement on this agenda is so far very weak. There is no much that has been accomplished. I think that theoretically speaking, we have all the elements already. So there's a couple of questions that I would like to raise. One is, there are two mechanisms, self-insurance and market insurance or market-based insurance mechanism. We all know that holding international reserves for developing countries is costly. We also know that there is a number of costs associated with reaching market-based instruments. But I have never seen a single study that compares both. Countries choose to accumulate, especially the poorest, to accumulate a lot of foreign international reserves. On the other hand, we tell them, yes, that's costly. But we never tell them how costly one instrument is relative to the other, one alternative is relative to the other. I've never seen a study that compares cost. Okay? I've seen arguments for why is both, and Hugh has explained to us why both of them are costly. But how is one relative to the other? The second one is that, yes, of course, when there are market imperfections, we need the role of the is IFIS? I mean, okay, because IFIS is in Spanish, you see, so sometimes I never know how to, okay. There is a role for the IFIS, certainly, there's no question about that. But if we go country by country, it's going to take forever. What about designing some form of IFIS-led or organized pilot program for either GDP index bonds or trade index debt that would include small countries from different regions? The advantage of a pilot project, first is pilot, so it's contained, right? So you can actually learn the same way I learned from the previous crisis to say something about the forthcoming crisis. I'm not very enthusiastic, so I said forthcoming crisis. But there are two things that we get from this. First is that the IFIS could have an identification of those costs, administrative and design costs, which could initially be absorbed by the IFIS. That's the part of the subsidy component from this kind of program. And the second one is bringing the private sector would be kind of, I think, relatively easier because it would include the diversification across regions. And so that brings the pooling element that Hugh was mentioning in the paper. Okay, so I know I'm up to my 10 minutes. I think the IMF paper has been, or is great, and I'm looking forward to see more of this in the future. Thanks.
Can you leave that slide? Sure.
Liliana, thank you very much. You've not only provided some comment on the paper, but I think put forward ways to move this agenda forward. People who know me here will know that I'm not an economist. I've been surprised in the discussion so far to realize that the discussion about contingent finance didn't seem to have moved forward. I thought we were going to hear that there were some new instruments. We haven't heard that yet. I'm hoping maybe we'll hear more from Steve about the direction that we might go. So I appreciated this sort of concrete call for what seemed to me as a non-expert to be quite feasible steps. Our final speaker is Steve Radelet. He's the chief economist at the USAID. Before that, he was a senior advisor for development at the State Department. And before that, I'm very proud to say he was a colleague here at the Center for Global Development. Steve also has, among other things, worked in Indonesia as an advisor and served in the Peace Corps, if I'm not mistaken, in Samoa, which sounds like a terrific assignment. Steve, I'm looking forward to your comments. And I'm sorry? I'm looking forward very much to your comments, and welcome back.
Thank you. When you're a Peace Corps volunteer in Samoa, we call it the Beach Corps. It's actually a pretty good assignment. It's great to be here, as always. Thank you for the introduction. Thanks you for your presentation and your paper, and Liliana for your comments as well. It's hard to be the last speaker on a depressing topic. But that's my job. I'll try to be relatively fast, but I'll start with something positive. All three of the speakers mentioned how well developing countries responded to the shocks a couple of years ago. And I just want to underline how important that is and what it indicates about progress in developing countries, and particularly in institution building and capacity building in developing countries. Any of you that are, and most of you are, professionals in development have heard all of the bemoaning about how difficult it is to build capacity in developing countries and to build institutions. And often I see and hear people kind of throw up their hands like it never happens. Well, it does. And the response by developing countries 2 years ago to the global economic crisis compared to the responses 20 years ago or 25 years ago to the global economic crises in the 1980s is astonishing and shows the extent to which the development community and countries themselves have built the capacity, the institutional capacity and the professional capacity to build with to cope with macroeconomic crises. And I think it really is a testament to the fact that over time, slowly, hard to see it, year by year, actually there is great progress in building capacity. And we see it here in macroeconomic policy. Central banks today are so much stronger than they were 20 years ago, thanks in large part to the capacity building done by the IMF, ministries of finance as well. And it's not just in financial stuff, by the way. I think we see this in health policy and lots of other places where the capacity of policymakers and technical experts in developing countries is just vastly greater today than it was 20 years ago. And that's one of my lessons and takeaways from the response to the global crisis 2 years ago. And that's the very good news. And that, I think, suggests at least some degree of optimism if, in fact, these countries are faced with another crisis. We do have policymakers in many of the most important countries who are some of the best economists in the world, whether it's Ngozi Okonjo-Iweala or many others like that, who are just in a whole different class of capacity than their counterparts 20 years ago. So that's the good news. The bad news is that the global economy doesn't look very good, and if you're not worried, you should be. Who knows what's going to happen in Europe, but it is very, very fragile. And if things break the wrong way, and the news out of Greece again today is not particularly good, or yesterday, and it spreads, the implications are going to be pretty profound around the world, in this country and in many developing countries around the world. So I think these risks are quite real. And it's made more difficult by the fact, in terms of developing countries, that aid budgets around the world have very, very little prospect of rising, and in fact there's a greater likelihood that those are going to shrink, at least from traditional donors. I don't have to tell you what the prospects are for USAID's budget. They're not very good. And we are faced at this time with huge demands from countries around the world, whether it's some of our big countries that we partner with, like Afghanistan and Pakistan, as complicated as those are, and in many ways getting more complicated, or in places like South Sudan, where today and tomorrow there's a two-day conference. I'll be speaking tomorrow down at the Marriott, where there's a major conference going on South Sudan, which is a more optimistic and hopeful story, but one that commands some of our resources. And so we, as an agency, as many other agencies, are facing a global situation where demands are rising and our budgets are at best going to be level in the coming years, and I think more realistically are going to shrink. So this is going to be difficult, and anything we do has big opportunity costs. If we begin to put funding aside for any kind of contingent system, that means taking it out of meeting today's immediate needs. And Hugh talked about the opportunity cost for countries themselves of building up buffers against shocks. Those same kinds of opportunity costs are true for donors or anyone else that puts ex-ante financing aside in case of some kind of disaster. So I'm certainly not allowed to advocate that you go advocate for larger foreign assistance dollars. I would never do that. But if you hear someone telling you to go do that, I would advocate that you listen to them and do what they say. So anyway, it's going to be a difficult time for us. There are a number of agencies that actually do engage in contingent financing and shock kind of financing. Actually, there's a lot of facilities out there. At USAID, we spend a lot of our money actually dealing with shocks through food assistance, through disaster assistance, through our Office of Transitions initiatives, and many other things that actually fall into this rubric of contingent financing, where we have funding available for disasters and in advance. Every year we budget for them. We don't know where those disasters are going to happen, but we, in effect, have contingent financing available to go in and meet some of the world's greatest kinds of shocks, not from a macro perspective, but from either some kind of natural disaster or a food shock. And we have many of them going on right now, of course, the biggest in the Horn of Africa. So there are large types of contingent facilities like that are available. And of course, we have many others. On the macro side, the IMF, in many ways, is a contingent financing facility. That's not its only reason for existence, but it's one of its major reasons for existence, especially in developing countries. It has many others, surveillance and lots of others, but one of its biggest is that it acts as a contingent financing facility that countries put in contributions, their quotas, to be part of the co-op, in effect, that is the IMF, that gives them rights to draw out certain amounts of money when they need it, and multiples of those rights under certain conditions. That's basically the basic operating system of the IMF. And countries, of course, only do that when they need to, when they are facing some kind of risk. So we already have major facilities in place that do that. And so the question, I think, becomes, I think we should always be exploring new instruments, but I'm not completely convinced that we need new instruments. It may be that we need to refine, revise, and bolster the instruments that we have. I'm not sure, and that is a reference to Liliana's first question here. It could be the case, but given the fact that we do have a number of facilities out there, I'm not sure, it's not clear to me whether what we need is new facilities or whether we need more flexible versions of the facilities that we have that are able to move faster, perhaps with larger amounts of money, perhaps have variations that allow greater flexibility and greater speed rather than some new fundamental instrument. It could be. But in many ways, what we have are pooled systems where countries do put funds in to the IMF, and the World Bank does this to some extent, and as I mentioned, we do it as well, that are available for countries to draw on in times of emergency. So I think we'd need to compare the relative cost between not just these two approaches, but the approach of building on the facilities that we have. And the fund does this all the time. I'm not at all suggesting that the fund is stagnant. Actually, in the last few years, there's been many changes to make fund instruments more flexible than they had been in the past, with great improvements. And I think maybe that should be explored as well. Let me mention a couple of specific ones. The loan contracts, which is Liliana's second point, was one that I was going to mention. And I think I like this idea a lot. When I think about the idea of debt instruments where repayment is based on a country's repayment capacity, it's when you think about where the loans are and where you might start something like that, it seems to me we ought to think about having pilot programs within the fund and the bank where they use the debt instruments that they already have and modify those a little bit, that under certain circumstances countries would pay more when repayment ability allows them to do that, and pay less in other circumstances. So we could start with that. Harder to think about that in the private sector with countries, for example, issuing a bond that might be indexed to that. You could do it, but you know, if you're going to allow countries to pay less when times are tough, then they've got to be paying more when times are good. And most countries aren't going to be particularly willing to pay a premium on their debt service today because sometime in the future, maybe or maybe not, they'll pay less when times get tough. So in effect, if you went to a pure private sector instrument, they'd have to be paying more. And that's at the core of any kind of contingent self-financing, whether it's insurance or anything else. We all pay insurance. You pay a little bit now, but you may or may not ever have to redeem it in the future, unless you're Joe. Where's Joe? Yeah, Joe redeemed all. It's a personal story, but Joe redeemed all of our insurance premiums for us in the last few months when her house was damaged by a hurricane. So anyway, so maybe that's a story about why we should have these contingent facilities. So I think those kind of contracts could be explored, but I would like to see some pilots from the IMF and the World Bank first. Another thing that you could explore would be contingent credit lines, especially perhaps drawing on some of the new financiers out there, the BRICS, India, China, Brazil, and others that might be willing to use some of their reserves as contingent credit lines, with lines of credit to developing countries, particularly if a repayment to those lines might be partially subsidized by the fund or the bank or by somebody else. So we might be able to come up with some new kinds of instruments there that took advantage of the fact that there are quite large reserve holdings in some countries that might be willing to extend contingent credit lines. So maybe. But generally, I'm kind of skeptical on the hedging or insurance for the very reason that Liliana points out in her first bullet. They're costly, they're expensive, and it's not clear to me that it's a cost-effective way for countries to engage on this. So just to kind of summarize, I think we need to explore building on the facilities that we've already got. Second, looking at these debt instruments or perhaps contingent credit line. But then third and finally, actually I didn't say this, but to summarize it, given these problems, I think the fact is that developing countries themselves are going to be faced with much of the burden if in fact there is another shock. And what that means is that all of us need to be working with developing countries now to try to work with them to build up the buffers as much as possible. I know that if I was back working as I once did with Liberia or other countries, I would be advising them right now, don't bet that there will be donor financing available if there's another shock. You've got to start shoring up the house now. And if there is financing available, fine. But while things are relatively good, build up your buffers as much as you can now. Make those adjustments as much as you can now, because I suspect that if there is a major global shock, a lot of the burden is going to fall, unfortunately, on developing countries themselves. So on that not particularly optimistic note, let me stop right there. Thanks.
Steve, thank you very much. I want to ask our presenter and both of our panelists to come to the front now. Please join me here. I want to do this a little differently because I know there's a lot of knowledge in the room, and there'll be both comments as well as questions. And rather than take them individually, I'm going to ask you to keep your comments and questions short and concise. Identify yourself. A microphone will be available to you. And then I'm going to take them all at once, let each of our discussants respond, and then Hugh, I'm going to give you the final word to respond if you wish to either of the discussants, but also to the comments from the floor. One of the things that crossed my mind thinking about this, and I'm particularly interested in comments and questions about how we might move forward, whether we need greater flexibility, as Steve suggested, or new instruments, and what might be done to provide those, is whether or not, and I pose this as a comment along with those that will come from the floor for you to think about, whether or not one of the problems, in fact, is a capacity constraint in the kind of expertise that we have in this room, that if everybody who does this kind of work is thinking about Europe, is there enough, not only the expertise we have here, but the policymakers' ability to make decisions to actually do new things? And is there sort of a cost to the distraction of constantly be thinking about what is it that we need to do to help the rich world, and therefore we don't really have the decision-making capacity to deal with the problems that it throws off for the poorest? That's my comment. I see, is it Jo Marie in the back with her hand up? Would you like to go first? Please identify yourself.
Yeah, hi. This is Jo Marie Grease Grabber at New Rules for Global Finance, and yes, I did blow all of your insurance investments single-handedly. I'm going to be very quick. I think Liana's idea of ability to pay is a great idea. I would like to know why we don't spend more effort in preventing crises than responding to them. For example, can we keep speculators out of the food and fuel business and just say, no, you can't put your money there? I want to be radical. Why do we have the private sector controlling the lives of the planet? I want to have a confiscatory policy. If there's all this money floating around and it's harming real people, why is that allowed to continue? Taxes are an option that a lot of people are exploring, whether it's in extractive industries or transfer pricing. I hope the fund is supporting that. And what can China expect to get for large investments in the IMF?
Thank you for considerably expanding the realm of things being discussed here. Who else would like to go? Yes, ma'am.
Ms. Okida from the World Bank. I have a question to Hugh. One of the long-term strategy to increase the resilience to shocks in developing countries, you mentioned two. One is to promote diversification of exports, and the other was deepen the financial market. I agree basically with those two prescriptions, but on the latter, we saw, at least on this crisis, the financial crisis in 2008, that deep financial market and the integrated financial market to the rest of the world was a bit of a mixed blessing in terms of opening up another channels for contagion of the global financial crisis. What were your rationale for still encouraging, as part of the strategy for increasing resilience, to deepen the financial market in developing countries, I mean the low-income developing countries?
Thank you. Gentleman here in front, and then Nancy Alexander in the back there. Use the mic, please, sir.
Ibrahim Lipumba from National Endowment for Democracy. I would like to ask on the issue of the stimulus packages after the crisis. Has the IMF done any kind of evaluation of these ones? How effectively they were being used? In some cases, you could put more money on investment and hence have more growth. And in some cases, you had a lot of problems of the money really leaking to people who basically stolen it. And secondly, on the self-insurance, to what extent is the evaluation of public expenditure programs quite important in terms of focusing on areas that are critical for the development of the country, so as to be part of self-insurance, taking into consideration the coming crisis?
Thanks very much. There in the back.
Thank you, Nancy Alexander, Heinrich Boll Foundation. Really great presentations. My question is about fiscal trade-offs. And as you probably all know, the Group of 20, along with all the multilateral development banks and many developing country leaders, have a very strong consensus that is, to a certain extent, equating growth with infrastructure investment, and has projected and has, bankable project pipelines in all the regions of the world that, equate to 1 or 2% of GDP in some cases. And my question is just, if the crisis materializes as badly as some people expect, will there be flexibility to provide the kind of Social Security and health care and education and basic social and pension protections? In other words, can there be mid-course corrections of a potentially rather dramatic nature if the crisis develops? I'm not opposed to infrastructure, but I am in favor of protecting the most vulnerable in times of greatest need.
Thank you. There's a question way up in front here.
Thanks. I'm Paul Eisenman, independent consultant. I thought the three presentations were really terrific and complementary. And the questions, too, including very much the last one. Basically, the bottom line for me it would be to endorse what Liliana is proposing. Her table showing different country vulnerability indexes dealt with a question that I had in mind in listening to Hugh's excellent presentation. And that is, what would be the distribution of vulnerability by region? And what would be the distribution if the weighting were by population and not just by country? Because just looking at your table, it looked like there were a bunch of small countries in the upper left and some bigger ones in the lower right, even among the lower income countries. So having an idea of where the concentration is then seems to me has some real implications for what are the steps that ought to be taken. And if there is a particular concentration by region, by population size, if it's particularly smaller countries, that would certainly lend support to your proposal that it would be good to try and experiment with some group of low-income small countries. And I think Steve's point is very good about there being lots of institutions and instruments today. So, this really is about the non-traditional side of contingent financing. It's not one or the others. And in that case, it seems to me donors, multilateral, IFIs, MDBs, and bilateral could really play a useful role, because that can help deal with the issues of capacity that Hugh raised, can also deal with some of the risks of abuse that we know about as we see on television, questioning of ex-Senator and Governor Corzine. And it can also deal with the issue that Steve raised of willingness to pay. People don't like to pay when things are good. So it seems to me it's very much, Liliana's idea is very much worth pursuing. And I wondered if you had any comment about the particular intensity of vulnerability, whether by region or by population size. Thanks.
Paul, thank you very much. I see two more hands. I'm going to take very briefly the question up front here, and then the lady in the back. So first up front here.
Elizabeth Stewart from Oxfam. Hugh, you mentioned the tension between spending money and building up policy buffers, building up reserves. What's the fund's position on, instead of the money sitting in the central bank, those reserves being spent now for building resilience in country?
And the final question or comment, and I'm going to give our discussants and presenter here a moment to organize their thoughts. I've set a tall task for them. So please go ahead, and please identify yourself.
Yang No-yoon, Foundation for Empowerment. It is sort of related to the last question. And then in some sense, this financial crisis in the developed world has been contributed by the self-insurance, which the East Asian countries built up since last 1997 financial crisis in East Asia. So China and all other formidable East Asian countries such as Korea and Japan and Taiwan have accumulated humongous amount of the money, and then which could constantly finance this Americas and others prodigal behavior. So I'm wondering how. First of all, my question is how the self-insurance can be reconciled with the IMF's policy. So first of all, Steve's point was very good that whether the China or other BRICS can really lend the money to the LICs, not only to potentially to Europe. And second, then what kind of what kind of role IMF can play? Second is, can we learn something from the China's experience to have such a high self-insurance and what they are doing with their money and things like that? Third, in the long run, then what would the IMF do not to really make that kind of self-insurance to lead to another financial crisis in the future, in the long run? Thanks.
Thank you very much. Would Steve or Liliana, do you have preferences as to who goes first? Liliana went first last time among the discussants. Steve, to you, and then Liliana, and then Hugh, I'm going to give you the last word. Steve, one thing I was thinking about, you're saying there's quite a lot of contingent financing already in place, and I'm thinking, a lot of that is sort of earthquakes and weather and thing we might call acts of God, and it seems like the more difficult challenge is things that are also beyond the control of the low-income countries, but are the outcome of mistakes in the economic management of the rich. And I think that's a useful distinction. And is it maybe too much to expect that institutions like the IMF and the World Bank, which are dominated and run by the high-income countries, are going to be able to become effective agents for providing contingent financing against the acts of those same countries that run those institutions?
Thanks. On that particular point, the facilities that we run at USAID are in fact more around natural disasters, act of God, and less around macro, although we have some flexibility when countries do enter a difficult time to increase our financing. The IMF, on the other hand, is set up for macro problems, whether those are induced by the country's own actions or whether they are induced by shocks, global shocks from the rich world. So we do have those facilities in place. As Hugh mentioned, because they are ex post, sometimes they're too slow and not very flexible because countries have to negotiate a program and all of that stuff. But still, I think we should explore building on those. I don't sense, I certainly didn't sense 2 years ago in the last crisis when more countries did use IMF facilities, that there was any resistance by rich countries to using those facilities, even though those shocks 2 years ago, arguably a lot of that was caused in rich countries as well. So I don't think there would be a resistance to using the multilateral facilities. I think there might be more resistance if countries came, frankly, to the United States and said, you caused it, therefore you owe us. Even if that's true, and I might personally be sympathetic to that view, I don't think that a lot of other people might be. So in fact, because of that possible political reaction, I think the international financial institutions might be the best place to go. A couple of quick points responding to the other questions. A couple of Joe Marie's questions. On the point about preventing crisis, thank you. Actually, I meant to mention at least something about that. I think that's absolutely right. To some extent, our food security program, Feed the Future, is exactly meant to do that. It grows out of the food shocks over the last many years and finally has led to what many development experts have been saying for years, that development institutions have been underinvesting in agriculture and food security. So it is exactly what we are trying to do through that food security program, is to strengthen developing countries' ability to to be able to respond to shocks, in the first instance, agricultural food security shocks, but frankly, any shock, because if you are stronger in terms of your food security, even if you're hit by an oil shock, it gives you at least some buffer. So I think that's exactly right, and we ought to think more broadly about how we can do that. But it's a good example. You mentioned China. A couple of other people mentioned China. You know, one of the really interesting issues, I think, facing the world, and don't read too much into this, but it is quite possible that China, with its very large reserves holdings, does become a financing facility for countries, and in fact might become a little bit of an alternate to the fund. That many countries might, instead of going to the IMF, might turn to China and say, you know, we'd like to borrow a very small fraction of your multi-trillion-dollar reserves and borrow $10 or $20 billion, and I can see where that could really be an inviting prospect. So far, China has resisted that in terms of getting involved in the European crisis, but the idea of turning to China to purchase Greek bonds moves us into that direction if China does decide to do that. I'm not at all sure whether that's a good thing or a bad thing. In many ways, I think it could be a good thing, but it depends on what the quid pro quo is, would be for that kind of financing. But I can easily see a scenario in the coming years where the Chinese government, as by far the largest financer, at least for potential financing in the world, the largest war chest of anything or anybody, could move into that game. So I just put that out there as something that might develop in the coming years. Nancy raises this issue about, you know, diverting savings to safety nets, and you know, I'll only say that is the critical question whenever a crisis hits, whether it's a crisis that your family has to deal with or a country itself, is this issue about making these choices between savings and investment or dealing with immediate needs. And there's no easy way around that. I think if, in fact, other than to say that during a time of crisis, that's exactly when you have to cut back on future investment and draw down your savings to meet those needs. So I think those choices do have to be made, and it makes perfect sense to do that. How that operationalizes itself in terms of fiscal policy in developing countries means cutting back on development expenditures in order to have more flexibility on the safety net side. It's very hard for countries to do that quickly, but at least on the margin, it's the sensible thing to do. On the issues around the vulnerability index, Paul, your questions, I think that makes a lot of sense, but the issue is that the vulnerability, identifying it depends so much on what you think the shock will be, right? If it's a food shock, if it's a commodity shock in metals, if it's an oil shock, or if it's a generalized slowdown in world economic growth because Europe goes in the tank, the answer to your question would differ to a very large extent. So it would be it's pretty shock specific, I would think. Now we have some idea that wouldn't preclude you from doing exactly what you suggest in a scenario with a shock A, shock B, shock C. But I think you would have to think about it in terms of different shocks. One quick comment, Liliana, on your vulnerability index. In your three components, I didn't see reserves in there. And I wonder if you might think about, instead of a debt GDP indicator, it might be a debt reserve indicator or a short-term debt reserve, because reserves are such a helpful piece of the vulnerability. Anyway, just one quick comment. And then finally, on this issue that you raised about reserves and do you spend those now, it depends on how many reserves you have. Look, if you got a lot of reserves, yes. But if you start getting down to, say, 3 months of reserves, there are really high costs to depleting your reserves. If countries run out of reserves and the exchange rate really starts moving because you're out of reserves, there are really high costs associated with that. So now, on the one hand, reserves are reserves. They're meant to be drawn down in times of need, but within limits. So, you know, if a country had 5-6 months of imports, fine, draw some of those down. But if a country's getting down to 3 months of imports or below, you got to be really careful, and I would advise against drawing on those unless the crisis was really bad and you might draw down a little bit. But if there's anything we know about financial crises, it is that when countries deplete their reserves, things really get bad fast. So you don't want to draw those down too much.
Steve, thanks very much. Liliana, I don't expect you to handle all of the questions, but those that particularly interest you.
All right, very well. Regarding your questions, if you look at the table, you could recognize that most
Turn on your mic, Liliana.
that most are small African countries. So yes, there is something to say about regions that I didn't want to expand because there are so many regions. But yes, are small African countries the ones that are the most vulnerable. Regarding the issue of reserves, and actually, Steve, I am working on a much richer indicator that have many more components. This is a summary. But there is something I want to clarify that many people don't understand. Think of Europe right now and think of banks in Europe right now. What are they doing? They are increasing the amount of deposits that they have at the European central banks. They are moving towards more liquidity. The most important topic or fear that anybody coming from the financial sector, the corporate household, whatever, face is that they could run out of liquidity. So when people talk about the issue of reserves, countries do it from the sovereign point of view for the same reason, to have liquidity at a time that is needed the most. The Argentinian crisis didn't happen because Argentina was poor. Argentina is a very rich country, but couldn't sell like this the land and the cows, right? So that's why it accumulated reserves. That's what banks right now are accumulating reserves at the European Central Bank. So, this is a very important issue. Liquidity, the concept of liquidity, is something, by the way, when I was at the fund, I had this fight over and over again because liquidity, from my point of view, is a fundamental. And, well, that's another issue, but I think that this is a very central topic. Regarding the question of the development of capital markets, I would be very careful of throwing the baby with the tub. No. The fact that things are not well managed does not mean that you have to eliminate the instruments. Think about countries where there are not capital market developed. They are dominated by banks. There is no competition for banks. So actually, the fact that you say that some people think, okay, if we don't have capital markets, then we're going to be better off. No. That's not the case. You want to eliminate the banks too? Well, then we're moving to an economy where you basically say cash economy, and that doesn't make any sense either. So also, having better capital markets allows for development of pension fund systems. There are so many things that could promote welfare, that are welfare enhancing. So the fact is that in a number of cases, we have not had a good process of development of instruments that are helpful for the population. So we need to think about ways to better implement those as opposed to, let's kill them. And finally, on the question that also Steve answered somehow on that, and it's on the fiscal trade-off, the infrastructure versus social safety nets. Well, that is all under the topic of what is called fiscal space, right? The truth of the matter is that in the previous crisis, countries have plenty of fiscal space, and some of them actually conducted countercyclical fiscal policies and actually used resources to protect their safety nets. They didn't go into building infrastructure because that takes a long time, and no. They went into protecting the safety net. The problem that we have right now is that after that expansion, many countries have not gone back. They, when you want to use something countercyclically, okay, if you're in a bad situation, you expand the fiscal, but then you're supposed to contract. Examples of countries that have managed very well and has as much fiscal space now as that they had in the past is Chile, for example. Brazil is not, and so on and so forth. But the fact is that, again, depending on the country, we can certainly design ways to better the management of fiscal.
Thanks very much. Hugh, I'm going to ask if you can possibly, in just a couple of minutes, give us your key ideas, because I know you won't be able to answer everybody, but I'm going to give you the closing words.
Okay, thank you very much. And thanks to all who've participated in asking questions and giving us comments. I very much agree with everything that my panelists have said, so I don't need to repeat any of that. Let me just pick up on a few other points. First, on this question that Liliana put on the table of the relative cost of self-insurance versus contingent instruments, I think this is a very interesting and important question that I think we could look at further. We have done some recent work in the fund on trying to get a better handle on the opportunity cost of self-insurance per se, i.e. reserves, to try and get a better notion of what would constitute optimal reserve holdings for countries, going beyond the standard 3-month rule, and that was quite a successful piece of work that's produced some useful tools that we're now applying in the fund. We could look at extending that work, I think, to see whether you could apply it to look at the relative costs of the two types of support. In terms of the IFI's role in this, we did. I didn't have much time to elaborate on it, but the paper does actually talk about the role that the IFIs could play in solving some of these collective action problems that are holding back the development of these markets. Exactly some of the ideas that Liliana mentioned, contributing on the design aspects, on sort of things like data verification, which you would need for these to work properly, the design of the indexing, and so on. What is not clear is on the debt instruments, how much appetite the shareholders of these institutions will have for going down this route. The French Development Agency, which has pioneered this, have been trying quite hard to get other donor agencies interested, and have so far not succeeded. I think part of the problem is that donors, want to maintain discretion and control over how they're using their resources from year to year for some of the reasons that Steve mentioned. That's going to be a difficult thing to overcome. I think some of the lenders, though, who do provide long-term credits where there's a lot of room to move debt service payments around within the term of the loan, according to repayment capacity. We would certainly, favor those types of lenders looking at it. And people were asking, what can China do? China is now an increasingly important lender. Their loan contracts could, if they wanted to do even more good for Africa, one thing they could do is look at maybe making their loan repayment terms contingent. As far as the fund itself is concerned, as Steve said, you can view the IMF, in fact, as one big contingent financing instrument. But of course, the instruments that we deploy, the specific facilities we deploy, vary significantly in terms of the amount of contingent support, amount of ex-ante support that is embedded in them. Some of them are very much ex-post in the sense that countries can't be sure how much they will get or on what terms they will get if in the event that a shock hits. But increasingly we have been trying to build in more ex-ante features, making the access more, the eligibility criteria more clearer and more tightly defined. We also have, in the low-income area, have introduced for the first time precautionary credit lines, which essentially provide guaranteed contingent support with no additional conditionality added. And next year we're going to be reviewing our facilities again. I think we will look at making a few further sort of baby steps in that direction. Just two other questions I wanted to respond to from the audience. One is this question of deepening of financial markets, and will that contribute to resilience, given what we've learnt about the damage that financial markets can do when they're dysfunctional. And that's an important point. The work that I was referring to is work that's only just beginning. So I can't tell you what our policy prescriptions are, but in designing this project, we've very much gone into it on the understanding that we need to look at both the costs and benefits of financial deepening, and looking at country experience and how you mitigate the risks involved in doing this. But having deeper financial markets doesn't necessarily mean that you're exposing yourself to more risks. I mean, deeper markets, for example, deepening local financial markets in Africa, for example, could mean not necessarily increasing your reliance on external funding for your financial markets. You could actually reduce the reliance by mobilizing more domestic savings. Likewise, to the extent that you can expand access to credit to beyond the fairly narrow groups that are currently able to tap credit in many of the low-income countries, you diversify the effect of shocks. You give more people access to cushions that they can draw on when shocks hit, so you can actually reduce risk that way. And finally, in terms of this question of the fiscal trade-offs and how stimulus measures were actually adopted last time the big shocks hit, we haven't done a full sort of retrospective because, in a sense, the crisis is not yet over, and we will look at it, I think, when it is. But our initial take, which we published in a paper about a year ago, came up with some fairly positive findings in terms of the composition of the stimulus measures. Some of the biggest spending increases were in the sort of growth and social development friendly sectors, if you like, health and education, and there was actually some scaling up of investment spending as well. So I think these were not only sort of short-term stimulus measures, they were actually developmentally and sort of growth-friendly measures as well. I'll leave it there.
Hugh, thank you very much. I want to thank our audience, those of you who are still with us, and again apologize for the glitch which made the event a little longer than it would have been. Please join me in thanking our presenter and both of our discussants.